If you're retired or getting close, you've probably seen a dozen market predictions already this year. Recession, rally, rate cuts, who knows? But here's the truth no one talks about. Year after year, those forecasts are mostly wrong, and yet nobody actually goes back to fact check and see how they did. Hi, I'm Jordan Lehman, founder and financial planner at True Wealth Retirement Partners. And every day I'm helping my clients retire with confidence, creating income, investing smarter, paying less in taxes. So, in this video, I want to walk through a really powerful presentation put together by my friends over at Dimensional Fund Advisors, looking at how right or wrong the experts were about the market just last year, 2024. And you'll see why a steady plan beats shaky predictions every time. So let's have some fun and jump right in. So, market forecast versus reality. Let's start here. This is looking at the market performance for 2024, so last year. And it's looking at JP Morgan, Fidelity, and Goldman Sachs. And it's showing, okay, what were they saying going into 2024? And then did their tone change based on what they saw? So we'll start with our friends over at JP Morgan. This was December 2023. They said, we expect downside for equities from current levels. Bearish, this from their market outlook for 2024. Well, didn't really materialize. So like a good Wall Streeter, 6 months later, here's what they say. The U.S. economy should continue to provide a rising tide to support most investment boats for the rest of this year and into 2025. So they were wrong, and they changed their tune. Okay, what about Fidelity? This is November 2023. Barring something extraordinary, next year we expect to see the economy finally turn lower, as if that's what they want to have happen. I don't know. In June, right about the same time as their compatriots over at JP Morgan, what we're seeing in the U.S. is a resilient expansion. Well, that's great news suddenly. What about Goldman Sachs? This is November 2023. The current starting point will limit the potential appreciation for the benchmark U.S. equity index in 2024. Now, credit to them, they stuck with that for a little bit longer, but in October 2024, they said this: the equity market sell-off is canceled. It's like a declaration. That's nice that they let us in on that news. And a year-end rally is starting to resonate with clients shifting from hedging from left tail to right tail, whatever that means. Okay. So get this, 3 major Wall Street firms, teams and swaths of analysts making these predictions going into 2024, and then shortly after saying the exact opposite thing. Now, here's the key point. It's not just a prediction. It's that clients see these predictions and then make investment decisions based on it. JP Morgan. I mean, that's not your mom and pop shop down the street. That's JP Morgan. You see their ads on TV, the Golf Channel, whatever. It's JP Morgan. We expect downside for equities from current levels. So what does a client do? They go to cash. They own more bonds than they maybe should. They get out of markets in some way. To these guys, they make predictions, and then the next day there's new predictions. They're earning fees on the funds, and who cares? But how did that actually work for a client when they were wrong? Well, what actually happened in 2024? We're looking at the S&P 500 index, and the actual return was 23.3%. Not too bad a year for equities. We see the historical average. This is from 27 to 2024, 12.3%. We see that down here. Okay. What in the world is all this? These are our expert friends who predict the market for us and help us make tons and tons of money. Very kind of them. JP Morgan predicted about a negative 12% return for the S&P. Wells Fargo predicted about negative 3%. See, Barclays predicted 1.7% positive return. Bank of America, just shy of 5%, a little bit more bullish. How about the most aggressive? Well, first, I like my friends at Goldman, so let's give them some credit here. 7%. Oppenheimer predicted just shy of 10% returns. I mean, like, not even close. I mean, like, actually, not even close to what the real return was. If they really knew, don't you think at least they'd like average out to being like, sort of closer to what actually happened here? This is interesting. This looks at forecasts versus actual performance in recent years. Again, the S&P 500. This is 2020. Here's what we see. This is 0%. This is the black bar here. Above that is positive returns. Below that is negative. Here's the green dots. This is the actual S&P 500 return in these different years. Okay. Now, what about this lighter teal dot? This is the highest analyst estimate. Okay. So in 2020, just shy of 10%. 2021, we can see that here. And we see again here, just closer in 2023. 2024, we see the darker teal dot. This is the median estimate for the year, and the orange dot is the lowest estimate. Guys, it's fun. You look at these, and you do a little bit of prep for a video like this, and sometimes you're doing the video and you're looking back like, my goodness, it's just jumping out at you. I mean, they didn't. It's not just that the average wasn't even close. It's that actually, were they ever in the range from highest to lowest? This is the closest one, the actual return just slightly higher than the highest analyst estimate. But we see the actual return was never even within the higher low bar for the experts here. That's very interesting to me. The S&P beat expectations in 2020 and 2021, was much worse in 2022, and again beat in 23 and 24. If they actually knew, wouldn't you think they'd be at least closer on average? This looks at the S&P. This is from 1926 to 2024. Bumpy road to long-term average. I want to read this here, just verbatim. Annual returns came within 2 percentage points of the market's long-term average of about 10%. Get this, in just 6 of the last 99 years. These are those darker bars. 1, 2, 3, early 90s. This is just 2000s, mid 2010s. What does that mean? Here's what people will think. Well, the S&P, about 10%, and so they throw their money in, and what they expect is maybe it's 8, maybe it's 12, but it sort of averages out to about 10%. That's just not at all how it actually works. How it actually works is it's up 35, it's up 40, then it's down 20, then it's down 15, then it's up 30, then it's down 10, then it's flat, then it's up, and it averages to the 10%. It's just very interesting looking back at this. Again, this gold bar here, this is the average return. This from 27 to 2024. And the analyst estimates sort of hover at or below the average. And yet returns don't tend to actually land within the average at all. Again, they're making these predictions and investors are making decisions based on this. Well, what does that look like if you use predictions? Well, it's all shorter term. You're making assumptions about market performance that are specific and frankly have a poor track record of accuracy like we saw. You're subject to frequent revisions, like 6 months later, everything's changed apparently. And get this, it's based on an implicit belief that individuals can reliably outguess the market. I just don't see investors consistently and predictably beating the markets. Well, what's the alternative then? I would submit having a long term plan and a portfolio built based on your goals, not some expert's predictions, right? It's longer term. Yes, you're making assumptions about performance, but you're including a range of outcomes. It evolves gradually based on changes to your life and your plan, and it's based on an implicit belief that markets are generous to people who stay disciplined over time. This is looking at the growth of a dollar in the MSCI World Index. This is from 1970 to 2024. This is a starting point here. A dollar grew through 2024 to $117. And we see it had to overcome some pretty significant world events. Now, I wasn't around back then, but this is what my clients recall for me. US inflation, 13.5%. Dow drops 23% on Black Monday. Y2K, 9/11, Hurricane Katrina, 2008, S&P down 46%. Brexit, COVID-19. And despite that, the disciplined investor sees $1, every dollar, become $117 in this index. And this looks at 2024. Remember, we're talking about how right or wrong were they in 2024? Well, a dollar grew to $1.16. This in the MSCI All Country World IMI Index. And we see some highs and lows, right? Market surging to record highs, but U.S. housing starts fall to a 4-year low. Biden drops out, Kamala jumps in, Trump went. Think about how politically charged the last year was. Real life, real events, some positive, some negative, and yet markets were resilient and the experts wrong. Step back for a second. By the way, there's a link in the description if you want some help thinking through your goals, your plan, and how to build a portfolio that divorces you from predictions. Would love to have a conversation, get you pointed the right direction on that. I promise you, you're going to have more peace of mind when your portfolio and plan is built on your goals in a long-term way, rather than some experts' predictions on Wall Street. So hope you enjoyed this. Little bit of a different video kind of format here. So I think it's kind of fun just kind of sliding through some of these and a little bit more conversational. So hope you enjoyed it, and we'll catch you in the next one.